right, we are live. And attendees are slowly trickling in. We will wait 20, 30-ish seconds while people kind of log in, just to give everyone a chance. But in the meantime, as you come in, please be social, introduce yourself in the chat, say hello, where you're tuning in from. Make sure you switch the message to all attendees. Isle of Skye, nice. Some of the best hiking I've ever done was in Isle of Skye. Okay, we'll just wait a couple of seconds. Everyone trickles in. Right, I think we can definitely get started. So hello, Finimizers, and welcome to another Finimize live event. For those of you who don't know me, my name is Reda. I'm an analyst here at Finimize, and I'm really happy to host today's event on 5 portfolio hacks for busy investors. Sounds really enticing. And this event is with our partner, Prospero.ai. Now, before we get started, I just want to run through some very quick sort of housekeeping rules. So as you come in, you should see a poll kind of pop up. Please fill that so we get to know you better, essentially. And then second of all, kind of like I said at the start, as you're coming in, please feel free to introduce yourself in the chat. Tell us where you're tuning in from, and remember to switch the message to all attendees so that everyone can see your messages. Third of all, in terms of format, this is going to be a 15-minute discussion with our guest today, followed by a 15-minute audience Q&A, which takes me to my fourth and final point. Please use the Q&A box down below in Zoom to post your questions to our guest today. And if you see a question that you like, please upvote it so it moves on top, and that way we can get through the most upvoted questions first. So, without further ado, let's kick off. Our event partner today is Prospero.ai, a transformative fintech startup focused with a mission, founded with a mission to democratize access to financial markets. Now, it was founded by a former Wall Street hedge fund manager who envisioned a fair and transparent market no longer skewed in favor of large financial institutions. Their groundbreaking platform leverages the power of AI to distill millions of real-time data points on stock performance into simple, actionable insights, empowering both novice and seasoned investors alike. And today, I'm really excited to be hosting their CEO, George Kailas, with us. So just a little background on George. George has always had a strong aptitude for investing, to say the least. For example, he bought his first stock when he was 13 and worked at his first value investing hedge fund at 17. I tell you something, I was still in school back then. Now, this knowledge base, combined with a passion for tech as an equalizer, has seen him consistently ahead of the curve, not only by starting his first AI company at 25, but also by foreseeing a retail investor community that is well informed yet expects more. He combines deep empathy with financial expertise to develop unrivaled tools for retail investors, both in accuracy and simplicity. George, what an amazing story. Great to have you here. How are you doing today?
I'm doing great. I always love being on with Finimize, and thanks for the great introduction. Excited to dive in.
Amazing, thank you. And let's dive straight in. So I have a few questions for you today to kind of kick things off before we shift to audience Q&A. And starting off with the first one. So like I said, this webinar is for busy investors, and just wanted to kind of hear your perspective. What are the top sort of market indicators or metrics that busy investors should be monitoring regularly?
So, one of the reasons that I started Prospero is I think there's very challenging ways to get both, quality and speed. But, a few of the ways that I still use, that I have used in the past that are great check-ins are look at PE ratios, but benchmark it to the sector or their competitors. That's always a good way to do a health check on your portfolio or figure out if you want to get into a stock or do more research, just because that is, the point that you know the market already functions on. And a lot of the market cares about PE ratios. The second thing I would say in terms of a more fast moving market is just going to TradingView and typing in, going to the technical section, and it'll default to 1 day technicals. And they make it very easy to get a checkup on, individual stocks. But, don't be afraid to check up on things like QQQ, SPY to give you a health checkup on the general market. And then in terms of, what I use the most, other than those things, which I still do to diversify always, because it's always great to look at different sources, make sure you're, having kind of a board of directors of your investment committee is how I like to advise people. But, a lot of what we've created is to make that very easy in terms of a health checkup. So we have two long-term signals called upside and downside that, I can generally pretty easily tell you if you're thinking about going long a stock, you want the upside to be higher than the downside. And, looking at the time series of those values, there's a lot of things embedded in those numbers, like long-term options pricing dynamics, as well as, things like analyst ratings, price momentum factors, all kind of crunched into one number. And the second thing on the short-term side is net option sentiment, where you can get a feel for, net where institutions are betting and the extent that they're betting in real time scaled against 2,000 stocks. So you can get a really easy health checkup there that's kind of a richer number and more embedded into like what institutions are thinking in terms of kind of like older numbers. And like for that too, we have QQQ, SPY. So I think if you're looking at all of those things, especially, you're getting a pretty complete picture, I think, quickly.
Sounds really fascinating. And they say institutional money is smart money, so always a good idea to kind of see what they're doing. So fascinating stuff. Okay, kind of moving on a little bit and just sticking with the theme of busy investors. How do you reckon these busy investors should effectively diversify across different asset classes, or let's say implement sophisticated strategies, but without overcomplicating their portfolios?
I think the absolute best way to do this is to play to your strengths. And one of the things I give advice on young analysts that I'm trading is to specialize. You can't boil the ocean. You can't learn about everything in life. Go to what you're interested in. I tend to talk a lot more about tech stocks because I've always been interested in tech. And I was in a laptop program in 5th grade in my school where we all got them. So I've been in tech for a while. And that's, I feel like my advantage of even understanding the growth and the trajectory of tech. But what I always say is like, hey, if you're a doctor, you might have insights on biotech stocks that other people don't. Or even if you're an Uber driver, you might have thoughts on, the sharing economy and things like that. So playing to your strengths and your knowledge base is so important to be honest with yourself if you have an edge. That being said, I've got some other shortcuts along those lines. Like one thing that I always tell people, because people tend to be most interested in tech or consumer cyclical retail stocks. So instead of worrying about diversifying your whole portfolio, what you can always do is look at being predominantly tech stocks and then take something like SQQQ, an inverse of the top 100 tech stocks that can balance you out. That way, in bull or bear markets, you don't even have to worry about diversifying into every sector. All you have to do is pick stocks that perform better than the index. And you could do that same thing with consumer stocks by using SCC. That's an inverse retail stocks index. So I think that's the easiest, quickest way to do it. If you're looking at, not hedging, if you're looking at long only, which is been in everyone's comfort zone, I would just recommend a simple exercise of picking one stock in every sector and having that be your portfolio and challenging yourself to do that. If you want to go overweight some, that's going to increase your risk. But there's no better way to de-risk than just an equal weight single stock portfolio. And what's especially important on that is, the benchmarking again. One thing we always tell our users in terms of things like, we say net option sentiment, you want it to be greater than 50. But, we really look for that point to be above 80 in the short-term options markets to give you a good degree of safety. That being said, there's stocks like, finance stocks, energy stocks that tend to pay more dividends. So you don't have as much option speculation. So you're going to have lower sentiment numbers. So that's an example with even like an advanced metric like ours, you still have to benchmark it. So I think that that's the very important thing that you're doing. I think a lot of the times that stocks could just look more interesting because of things like growth prospects, because of what we're talking about. Finance companies don't care as much about growth. They care more about delivering profits and dividends. So a company that's throwing all of their money into growth is going to seem more exciting, but the discipline in the portfolio management there is ensuring that you cover all the sectors when a lot of them are going to seem less exciting. But you can always go with the first way if you just want an easier lift and to lean into, what is more interesting to you.
Makes perfect sense. Thank you so much for those insights. And maybe like a kind of follow up or a next sort of step question. So now let's say you've implemented your portfolio and everything. What role does portfolio rebalancing play in maintaining investment performance? And maybe perhaps the bigger question is, how can technology simplify this process?
Well, one thing that, I take a pretty hard line on, and I would encourage people to do the same, is I don't like automated portfolio management. And I don't like it for a very specific reason. If you're talking about automated portfolio management, whatever you have access to is going to pale in comparison to what the institutions have access to. And no matter how much people are selling on, blah, 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 these new tools, whatever, there's a simple fact that whatever product you have access to, you're likely outgunned in terms of money. The data history is going to be better. Not to mention, the engineering talent at these institutions and their ability to fetch information in a qualitative way that is just going to put you behind on that. So the best thing I can recommend for you is to learn tools like I'm suggesting, like Prospero, learn your own process and enhance it with AI tools, not in an automated way. That's the best favor you can ever do to yourself, investing in your personal growth and knowledge. But that is not necessarily for everyone, or maybe you just want to have a small percentage of your portfolio that's doing that generally increases. But other than that, you can't beat something like Vanguard Total Return, where they've optimized the fee structure, they've optimized the tax basis for it. They've done so much to lower the cost for you and really work on that diversification in a quality institutional way. So I wouldn't wander too far away from something like that if you're going to go in the automated way. But I would also encourage you to invest in your growth.
Makes perfect sense. Make sure you understand what you're doing, supplement it with AI, but don't just fully rely on AI or automated tools, right, to do everything for you, which I think is extremely sensible advice. Thank you so much for that. You kind of touched on this a little bit, but just kind of to hammer the message home. So for investors who are completely new to using technology for portfolio management, what are the first steps, in your opinion, they should kind of start to take to get started effectively? And maybe you can share some of your favorite online tools for portfolio management. I know you've shared a few, but if there are any others that stand out to you.
Yeah, I think that, one of the things that's a very easy way to get started is, what I would call enhanced dollar cost averaging, which is something that we've seen a lot of success stories with, and actually success stories with people that those tend to be people in their late 30s, early 40s that have done, conservative investing for a long time, but are looking at a way to, modernize a little bit. And it's just integrating the signals into a traditional, dollar cost average, equal deployment of your funds, into all of the names that you like, which is a very sensible strategy, especially when you're thinking of the most important thing in investing, taking emotion out of it. If you're doing a process, that's the most important thing. But, we've seen, our users have a lot of success in doing things like looking at our short-term signals like net option sentiment, net social sentiment, avoiding higher risk stocks like high dark pool stocks, high short pressure stocks, and still deploying a certain amount of capital every month into the names you like, just tilting it more into ones where short-term signals, things like technicals, other things that we're talking about, PE ratios, other benchmarking tools, all of that is a great first step in just pushing your comfort zone a little bit to get you closer towards portfolio management, because that's how you're going to do the best. If you take incremental steps to grow to be a portfolio manager. That's what I did. As was mentioned, I started when I was 13, but I've been taking these little steps, that have become bigger and bigger steps enhanced by technology by just being determined on that journey. And like most things in life, your resolve at the task is going to be the most important thing in your success.
Couldn't agree more. I have one final question for you before we move on to audience Q&A, and that reminds me actually. So for all the people tuning in, if you do have a question for George, please don't forget to put it in the Q&A box in Zoom, and we'll get to that in a minute. So kind of finally, George, I mean, you touched on this a little bit, but again, really want to hammer the message home. We talk about all the things investors kind of should be doing, but what, in your opinion, are some of the most common mistakes investors kind of do when managing their portfolios, and how can those be avoided?
The biggest mistake that I see, and it's not that different than life in general, is people going out of their comfort zone. We talked about the best way to do it going in their comfort zone. But like there is a path that I recommend, and I do a lot of, private investing tutoring to people for free. I did it even before Prospero because it's, one of my life's passions. And I've developed a path for people to walk. And I just think you have to take each step and don't skip steps. I think you should start with index funds, right? And then as you get more comfortable with something like Vanguard Total Return, Schwab Dividend, you start to see some stable returns, then you can start moving over to long only stocks. And then from there, one of the other steps I mentioned, long only, except you hedge with some inverse indexes. So you start to experience shorts, and then from there, long short, and then you can start getting into, option strategies and more exotic option strategies. And if you take those steps and make sure you're comfortable in each one and don't skip ahead, that's the best way to ensure your success. Most of the errors that I see people make are trying to skip steps before they've really gotten a good grasp on each one of those.
Makes perfect sense. Learn to stand up before you walk, right? Absolutely. Thank you so much for that, George. I want to move over now to audience Q&A, and the very first one comes from someone who's anonymous, who wants to know, or is asking, can you repeat the sources of the health checks? I believe this could be related to the upside health and downside health that you touched on. So what are some of the things that kind of go into calculating that?
Yes. So, I mean, I think you just want to look at, first, PE, benchmarking at the sector, benchmarking to competitors. Like, sector, you can generally see a good, benchmark by just like Googling sector average, if it's not apparent to you. But then I also would recommend going into Barron's, Yahoo Finance to look at closer competitors and just compare their PE ratios or other ratios. Like I also like enterprise value to revenue. Those are really good solid benchmarks to let you know, like, okay, where is the market valuing this and how do I build the story around it? That's the best health checkup, right? If you can come up with an easy reason why something has a higher PE ratio, great. You don't have to be, too stringent with the benchmark, but it's just information. Then I also said technicals. I like a quick technical check. You can go to TradingView. You can even Google TradingView in the symbol technicals. It'll take you right to the page. It defaults to 1 day. You can look at other time periods based on what you're comfortable, looking at QQQ or SPY. And then in terms of Prospero, which we pretty much built to do these easy health checks, there's some simple rules. We like upside to be at least 20 points higher than downside. We like profitability plus growth to be at least 120 or above, because you're basically saying both are in aggregate above average. We like net option sentiment to be at least above 50, but probably above 80 if you're looking at like a long-term long that's like kind of in the upper echelon of our picks. And then on the risk side, we like, short pressure, dark pool rating to be below 70 on a long or a short. And then, same social sentiment is similar to net option sentiment, greater than 50 is probably a good sign. Less than 50, a warning. But we think that I'd say in general, net option sentiment, upside and downside, those are going to be your best guideposts because those update every 3 minutes with the options markets. And those are going to get you out of trouble and sometimes give you opportunities that you wouldn't otherwise have seen.
Amazing thinking. And maybe to clarify to the audience, so when you're talking about option sentiment, are you kind of comparing the amount of call options to put options sort of outstanding and kind of comparing a ratio of the two?
That's a great question. And we actually focus on pricing a lot more. And this is like many years of experience in dealing with institutions too, because, an open interest or a put call ratio is only going to update once a day, right? And dealing with a number that was calculated yesterday in like a fast changing market is not what we'd recommend. So that's why we focus on pricing. We try to isolate institutional transactions to really get a feel of what that pricing is. And then we're just looking at, the extent the bets above where the stock is trading are greater than the bets with strikes above are greater than the puts with strikes below. And the other thing that's important to us, and we kind of, mentioned a little bit at the beginning, is like, AI, robotic signatures, as what we call them, are very important because, some of you might use products like sweep orders and things like that. And we actually devalue those because when an institution is, buying up the ask of a particular strike expiration pair, they know they're sending you that message. And my philosophy is anything that's costing an institution more money to buy that ask, to pay to send you that message, they're making more off of it than you're making off of it. So I try to avoid things like that. We look more for consistency. We look for what we would call robotic signatures. So a lot of concerted activity across many different expirations, across many different strikes, because that's what institutions do when they don't want you to know, when they think they've got some alpha that they're trying to hide from the rest of the market.
Amazing. Sounds very robust. Thank you so much. Our next question comes from Ben, who's asking, for someone focused on long-term investing, how do you recommend finding the balance of keeping close to your portfolio, possibly rebalancing, and not feeling the urge to make excessive changes when you shouldn't? Any tips on how often you should review your portfolio?
Well, I think first is like I'm going to give you, the advice that's the most advanced course in what I've learned in my investing journey, which is just like your philosophy, your attitude is the most important thing. And I'd say first you've got an attitude problem, like not like, personality, but in terms of your approach, just like the self-doubt, I don't know if I should be doing this, I don't know if I should be doing that. Like, I think you should figure out like, what honestly feels comfortable to you and what you want and what fits in your schedule, and then fit the strategy to what feels comfortable to you. Don't try to like look around and find a strategy that might not fit what's comfortable to you. That's being said, I think once you turn your philosophy around and say, hey, I think I can check this much. I like, these kind of hold times, but I'm willing to reevaluate on these basic conditions. I think that's the most important. Like one of the things for me that's helped is like, I used to have a lot of the same problems, even on a hedge fund side as a retail investor that you're talking about, where I was like, oh, the market's going in the other direction than me, but I still have some beliefs and I don't really know what to do. And I don't know if I'm managing risk properly. And that's like part of what we created at Prospero, where like, if you go in our app and you say like you could say like, hey, I have this long and, unless I see net option sentiment go below 50, I'm not going to touch it because that means overall institutions are betting more for or against it in the short-term options markets. And I'm just not going to worry about it unless I see that. And I use that all the time. That's helped me relax more.
Makes perfect sense. Thank you. And our next question comes from Jenny, who's asking, given so many retail investors lose money, with brokers all saying 70 or 80% on average, do you think too many of us are chasing stock picking and quick wins over just buying index funds and forgetting about our portfolio? I think it's a very good question.
I think too many people are making the classic mistake of being manipulated by institutions. I think the urge to look for quick wins is what drives people a lot to meme stocks. It's what drives people a lot to, a stock like Nvidia, where you're getting it like near its peak, and then it might drop, and then you sell because you're like, hey, this isn't the easy money I thought. And like execution is almost always the problem there. But I would say, in terms of the remedy for that, it's process, right? I think too many people are looking around and listening to what people around them say, and that they're making easy money. And you've got to think of this huge reporting problem that I think when I tell this to people, they really get it. Where it's just like, think about how many people just talk about their wins on the internet. How many people do you hear talk about those losses? Yet you see those numbers. And that's the real problem. When you're getting pitched these stock ideas, everybody's winning, it's easy, everything like that. And like the best advice I can give for you, and there are ways to win. I've seen a lot of our users win. I've seen a lot of people, change their process. And that's the most important thing. If you start saying, and even keeping a journal, if you're going to be really fastidious about it, this is my investment thesis. This is why I'm buying a stock. And then grading it out. And your investment thesis can't be someone told it to me on the internet. Like, there's a short squeeze, or like, those aren't real hypotheses about the company and its value or its interaction with market forces if you're getting to a more advanced level. But once you start focusing on process, then you can start improving and going on the journey, and you will take some losses on a good journey. Lord knows I have. But you got to keep with it. You got to learn. You got to be honest with yourself about what you know and what you don't, and you will get better. But if that sounds too arduous for you, yes, index funds are the right choice.
Amazing. Thank you so much. And our next question comes from Jamie. You mentioned options sentiment a few times. Do you leverage options in your strategy at all? Should retail investors consider leveraging them for protection with the likes of covered calls, for example?
First of all, I don't really like my option strategies on my own don't really include covered calls. I think I don't like them just generally. You're capping your upside, and you always have to remember the market goes up a lot more than it goes down. So you're basically like giving away your upside for, I don't think enough generally. There are exceptions to the rule. But a few things. Net option sentiment was actually built to let people see what was going on in the options markets and the institutional options markets easily without having to learn about options. Because as I said, I believe in a very strict course of education where options are the last, and you have to have success at every point. Indexes mixing in longs, like longs starting to mix in short indexes, then long short, then options, right? If you see success at every one of those places, I promise you will be doing well. And like, notice some of the ways I said, there's managing risk on the way. The example I gave of just like specializing to a certain sector and then getting a short index of that sector is the simplest way you can learn to manage risk, and shrinking the world for yourself, which is really important. Like you talking about selling covered calls when you haven't really gone through all those steps and seeing success, that's growing the world. And that's where you're going to get into trouble. Granted, I will say, in terms of, exposure to losses, covered calls are very safe. So I don't want to trash them too much as an instrument, but I just think what you're getting for that limited upside is not limiting your downside enough. There's better ways to do that.
Amazing, thank you. I think we'll squeeze in one final question before we end. This question comes from Shivankit asking, does diversifying into other sectors not provide better long-term growth rather than focusing on one sector and just hedging fully against that sector?
Oh no, I couldn't disagree with that more. Like look at like I think there's a stat, like if you even look at like the Mag 7 versus the S&P 500, like the last 10 years, like it's like maybe in the 50s or the hundreds, like how much more it is. Like specializing in something, especially tech that's so high growth, is definitely a better way to get growth than, diversifying sectors. Diversifying sectors is a different benefit. It's safer, right? You've got less downside. But, going long only, you're way more exposed in bear markets than you are in the strategy where I suggest where you pick a sector, specialize to it, and go get downside protection with an index short, inverse index.
Amazing. Thank you so much. I'm afraid that's all the time we have today. And just before everyone kind of leaves, just three final quick things. First of all, a massive, massive thank you to you, George, on behalf of myself and the entire Finimize community. That was really insightful. I know I definitely learned a lot, and I'm sure everyone tuning in learned a lot as well. So thank you so much for all of that, George.
Thank you. Thanks
Second,
for having me.
second quick thing, so I just have a plug. So please join us for the Finimize Modern Investor Summit on December 3rd and 4th. This 2-day event is packed with back-to-back sessions and workshops led by the biggest names in finance. So please don't miss out on this incredible opportunity to elevate your investment knowledge and network with fellow retail investors. And you can pre-register for your ticket using the link shared in the chat. Final thing, as you leave the event today, a pop-up survey will appear on your screen. Please take a few minutes to let us know what topics you're interested in hearing about at future events. That's all from me. George, once again, thank you so much for joining us and for all your incredible insights.
Thanks.
Thank you, everyone. I look forward to seeing you at the next event. Bye-bye.